This is MeetSean, where we break down real life topics insurance, annuities, real estate, travel planning, and home ownership so you can make smarter moves. Subscribe so you don't miss the next episode.
Welcome back to the deep dive. Today we are cracking open the vault on one of the most powerful tools for building financial freedom, tax-deferred investments.
That's right.
We've got a stack of sources here that lays out the strategy, the mechanics, and, the really crucial numbers you need to know to leverage them.
Exactly. And the mission today, it isn't just to list off accounts like IRAs and 401ks. It's to really understand how they work.
How they change your tax situation right now.
Right. And maybe more importantly, how they supercharge your long-term wealth through what our sources call the enhanced compounding effect. It's all about playing the long game.
Okay, let's unpack that core idea then, because on the surface, it sounds simple. Your money grows, you don't pay tax on it right away.
You delay it.
You delay it until you withdraw the money, usually in retirement. But what actually makes an account tax deferred? What's the immediate benefit?
Well, the immediate benefit is tax reduction.
Yeah.
Today. Right now, because the contributions to traditional accounts like a traditional IRA or a 401k are made with pre-tax dollars.
So you're lowering your taxable income for this year.
Instantly. You're shrinking the pool of money the IRS can tax you on for the current year.
And the sources point out this is a big deal. I mean, depending on your tax bracket, putting money into a traditional IRA could save you, what do they say, hundreds or thousands in taxes.
Right now, yes. It's a powerful instant return on your savings before it's even had a chance to grow.
So you get the tax break on the way in.
And then you start the real engine of growth, which is that enhanced compounding effect we mentioned.
Okay, walk us through that. Why is delaying the tax bill so much more powerful than just, waiting to pay?
So think about a normal taxable investment account. If your investment earns, say, $1,000 in 1 year,
Okay.
and you're in a 24% tax bracket, well, you immediately owe $240 in taxes on that gain.
Right. So you only get to reinvest the $760 that's left over.
Exactly. That's what they call tax drag. But in a tax-deferred account, since you're not paying that tax right away, the full $1,000 gets reinvested.
The whole thing.
The whole thing. And that full $1,000 immediately starts earning its own returns, which are also tax-deferred. It feeds itself so much faster over time. 100% of your earnings are working for you, not just 76%.
That's a huge difference. And it really tackles that anxiety some people have, the so-called tax trap myth.
The idea that you're just setting yourself up for a massive tax bill later on.
Yeah. But the sources show that the compounding just completely outweighs that future bill.
They do. They have a great table. It shows an investment growing at 5% a year. In the tax-deferred account, after just 10 years, you'd have $16,386.
And the taxable one?
The taxable option, where you're paying that 24% tax drag every year, only grows to $13,425.
Wow. That's almost a $3,000 difference in just a decade. Imagine that over 30 or 40 years.
It's a completely different outcome, just from delaying the tax.
Okay, so the math clearly works, but where do we actually put this money to work? The sources break it down into the big three vehicles.
And understand the specifics of each one is really important. They all offer deferral, but the rules, they're all a bit different.
Let's start with the one most people can open on their own, the individual retirement account, or IRA,
Right.
Specifically the traditional IRA. That's the one that gives you that immediate tax deduction on your contributions.
And we should probably just quickly mention the Roth IRA here,
Good point.
because people hear IRA and think of both. The Roth is actually tax-exempt, not tax-deferred. You pay taxes now, and the money comes out completely tax-free later. Different strategy.
A different tool for a different job. Okay, so next up, 401k plans. Most people get these through work.
The workhorse of retirement savings.
And the mechanism is basically the same, right? Pre-tax dollars go in, your taxable income for the year goes down.
Yes, but with one absolutely critical bonus: the employer match.
Ah, yes. Free money.
It is essentially free money. I mean, if your company matches your contribution, you are getting an immediate 100% return on that portion. You have to contribute enough to get the full match.
Non-negotiable. And the final one is a bit different, a fixed indexed annuity.
Yeah, FIAs. These are technically insurance products, not securities.
So how do they work? The sources say they're tied to a stock market index, like the S&P 500.
That's right. Their growth is based on an index, but it's usually capped on the upside. You won't get all of a huge market rally.
But the trade-off.
The trade-off is they promise a minimum return or, that you won't lose your principal investment. So it's a way to get tax deferral with less risk, focus more on preserving what you have.
Okay, so we have the vehicles, but once you start putting money in, you run straight into the IRS rulebook. We have to talk contribution limits.
Absolutely. You miss these, you're leaving tax advantage savings on the table.
So let's use the 2023 numbers from our sources, since that's what they detail. For a 401k, the limit was $22,500.
And for an IRA, it was much lower, $6,500.
Right. But there are also the catch-up contributions for people who are a bit older.
Yeah, for anyone 50 or over, they let you add an extra $7,500 to your 401k and an extra $1,000 to your IRA. It's a way to help people who maybe started a bit later catch up.
And we should probably mention, your income can affect whether you can deduct those traditional IRA contributions.
That's a great point. If you make over a certain amount and you also have a 401k at work, you might not get that deduction. It phases out.
Okay, so let's flip to the other side of this, the withdrawal process. You've done everything right for decades, and you retire. Now what?
Now the tax bill comes due. But the big rule to watch out for is the early withdrawal penalty.
The magic age, 59 and a half.
59 and a half. Take money out before then, and you're typically hit with a 10% penalty.
And that's on top of the regular income tax you owe on the withdrawal.
On top of it, it's a steep price. It's the government's way of making sure you use these accounts for their intended purpose.
Yeah. But there are exceptions, right? Because life happens.
There are some very important exceptions. The sources list a few. Things like permanent disability or death, and qualified distributions from a Roth account are different too.
And what about that term, substantially equal periodic payments? SEPPs. It sounds complicated.
It's a bit complex, but it's basically an IRS-approved way for early retirees to access their money. You agree to take a series of, substantially equal payments over a long period based on your life expectancy.
So it's structured.
Very structured. But it lets you get the money before 59 and a half without that 10% penalty.
Okay, this brings us to a huge strategic choice. How do you decide between locking up money in a tax-deferred account versus just using a regular taxable one?
It's a big question. We know with tax-deferred, you pay later. With taxable accounts, like one holding CDs or bonds, you pay taxes on the interest and income every single year.
And the decision really comes down to trying to predict the future, which is hard.
It is, but you can make an educated guess. The core question is, what do you expect your tax bracket to be in retirement?
So if you think you'll be in a lower tax bracket when you retire,
then tax-deferred is usually the way to go. You get the big tax break now when you're in a high tax bracket, and you pay the smaller tax bill later when your income is lower.
But what if you expect to be in a higher tax bracket later? Maybe you build a successful business or something.
If that's your projection, then paying taxes now could be the smarter move. That's when you might lean more towards a Roth account, where withdrawals are tax-free, or just a standard taxable account.
And we can't forget the big non-tax benefit of those taxable accounts, liquidity.
Freedom. Absolute freedom. There are no contribution limits and no penalties for taking your money out whenever you need it. It's your emergency fund, your down payment fund. You can't do that with a 401k.
All right, let's shift to maximizing growth within these accounts. It's not just about opening one. Strategy one is consistency, regular contributions.
This is so key because it takes the emotion out of it. It stops you from trying to time the market.
You're talking about dollar cost averaging.
Exactly. You invest a fixed amount every month or every paycheck. When the market is down, you automatically buy more shares. When it's up, you buy fewer. It smooths out your returns.
And the sources have that data table that's just so compelling.
It is. It showed regular contributions led to $15,000 in growth over 5 years.
Versus only $12,000 for a lump sum that was just poorly timed.
Right. Consistency just flat out beats trying to be a market genius.
Okay, and strategy two is rebalancing.
Rebalancing. Because your portfolio is not static. The market moves, and your mix of stocks and bonds will drift away from your original plan.
So if stocks have a great year, suddenly your portfolio might be, say, 80% stocks when you only wanted to be 60%. Much riskier.
Exactly. So the idea is to check in, maybe once or twice a year, and trim what's overgrown and add to what's lagging. Sell some of those high-flying stocks and buy more bonds to get back to your 60-40 target. It's about managing risk.
The sources also warn to consider tax implications when rebalancing. But why would that matter inside a tax-deferred account?
It's a subtle point, but important. While you won't pay income tax, some plans, especially certain annuities, might have internal fees or restrictions on how often you can move money between their internal funds. You just need to know the specific rules of your plan.
Got it. And finally, the silent killer of returns, fees and expenses.
They are the kryptonite to compounding. I mean, even a 1% difference in fees can cost you tens, maybe hundreds of thousands of dollars over a lifetime.
The sources list three main types. First, management fees. That's what you pay the pros. And the range is pretty wide, right? From 0.5% to 2%.
It's a huge range. Then you have administrative fees, just the cost of keeping the lights on for the account, maybe $25 to $100 a year.
And third, those surrender charges, which are mostly for annuities.
Right. That's a big penalty for cashing out early, separate from the IRS penalty. It can be 5, even 10%.
Right.
The lesson is you have to read the fine print and keep your costs as low as humanly possible.
Wow. This has been a really complete breakdown. We started with the basic benefit delaying taxes and moved right into the real power that enhance compounding. Then we hit the rules of the road contribution limits, penalties, and the key strategies like consistency and rebalancing to actually make it all work.
Absolutely. And you've learned that choosing the right account today really depends on predicting your tax bracket in retirement. So if you're already maximizing your contributions, the next step is to look at your own situation. And that brings up, I think, a really important question for you to consider.
Okay.
Beyond just estimating your future salary, what unexpected financial life events could totally shift your expected tax bracket in retirement? And how should that potential for volatility factor into your planning right now?
Something to mull over. Thanks for joining us for the deep dive. We'll see you next time.
That's it for today's MeetSean. If this helped, follow the show and share this episode with one person who needs it. See you next time.